You step into the office before the first meeting has started. The room is already awake, but it does not announce itself. No raised voices, no visible panic. No one moves like they are trying to prove they matter. The lights are soft, the desks are clean. Behind the glass, conference rooms sit empty, waiting for the conversations that will decide whether a company gets bought, refinanced, expanded, cut apart, or quietly rejected. On one screen, a folder is open. Inside it are financial statements, customer lists, lender notes, management slides, legal summaries, and projections written by people who need the future to look believable. Nothing has happened yet, but the machine is already moving. Because private equity does not usually feel powerful from the inside. It feels controlled, quiet, procedural, almost ordinary. The power is not in volume. It is in access. Access to information before others see it. Access to lenders who can turn a purchase into leverage. Access to executives who need capital. Access to investors who trust someone else to manage money on their behalf. And as you move through the ranks, what changes is not simply your title. It is what part of the system you are allowed to touch. At the bottom, you are allowed to see information. Then you are allowed to clean it. Then to build judgment around it. Then to influence a deal. Then to sit near ownership. Then to raise capital. And if you go far enough, you eventually realize that even ownership is not the final layer. Every level gives you more permission. Every level also takes away a different kind of freedom. Level 1. The information clerk. At this level, you are not making decisions. You are preparing the material that allows other people to make them. You read documents designed to persuade. You check assumptions meant to survive scrutiny. You compare margins, revenue growth, customer concentration, debt capacity, and management claims. Your job is not to sound brilliant. Not yet. Your job is to be accurate. A small mistake in your file can travel further than you do. It can move from your screen to a meeting, from a meeting to a memo, from a memo to a decision involving capital that does not belong to anyone in the room. That is the first lesson. You are close to money, but you do not own it. You are close to decisions, but you do not make them. You are close to context, but you only receive the part someone has decided you need. So you learn to be quiet, precise, useful. Because before the system lets you build a deal, it first tests whether it can trust you with the information underneath it. Level 2. The Deal Builder. Now you are no longer just cleaning the information. You are helping turn it into a case. The documents still arrive first, but they no longer simply pass through you. You organize them into a decision. You build the model, schedule diligence calls, track questions, compare management's story against the numbers, and prepare the memo that will eventually sit in front of people with authority. This is the first time private equity starts to feel real. Not because you own the capital, you do not, but because your work begins to change where that capital might go. A banker brings the opportunity into the room. A consultant tests the market. A lender studies the debt capacity. The management team explains why the next 5 years will be better than the last 5. Everyone has a role. Everyone has an incentive. Everyone needs the story to hold together long enough for a decision to be made. And you are somewhere in the middle, trying to separate a strong business from a polished narrative. You know more than outsiders now, but you still do not decide. You can influence the case. You can sharpen the questions. You can find the weak assumption hiding inside a confident forecast. But you do not have the final vote. That is the hidden cost of this level. You carry pressure without carrying authority. Level 3. The Pressure Bridge. At this level, the deal is no longer something you help assemble. It becomes something you are responsible for holding together. You sit between the fund and the company, between the partner and the associate, between the spreadsheet and the people who have to make the spreadsheet come true. The question changes. It is no longer only, does the model work? It is, can real people execute this plan under real pressure? The partner wants conviction. The management team wants room to breathe. The lender wants protection. The associate wants direction. And you absorb something from each side. You translate capital into expectations. You translate operations into risk. You translate uncertainty into language the investment committee can tolerate. This is where private equity stops feeling like pure finance. It becomes the management of belief. Everyone is being asked to believe in the same version of the future. Your job is to make that future look disciplined enough to fund, but realistic enough to survive contact with the business. And still, if all you can do is execute, there is a ceiling above you. The next level does not reward the person who only runs the process. It rewards the person who can create access before the process begins. Level 4, the access maker. At this level, waiting becomes a weakness. You are no longer valued only for how well you handle a deal once it arrives. You are valued for whether you can find the deal before everyone else knows it exists. So your work becomes quieter. You call founders who are not selling. You study industries before they become crowded. You remember small details from conversations that seemed casual at the time. A family business with no succession plan. A software company with loyal customers but no institutional capital. A founder who says he is not ready but still keeps taking your calls. Nothing looks urgent. That is the point. Origination does not always feel like persuasion. Most of the time, it feels like patience. You are building trust long before trust has a price. You are staying close enough that when the owner finally thinks about outside capital, your name appears before the bankers. This is where access becomes an asset. Not intelligence alone, not effort alone, access. The hidden cost is that relationships stop being completely innocent. A dinner is still a dinner, but it may also be a future transaction. A conference conversation is still polite, but it may become a proprietary opportunity 2 years later. Even your follow-up begins to carry economic weight. You learn to be useful without looking hungry. Because at this level, the best opportunities rarely arrive through the front door. They come through trust that was built before the process had a name. Level 5, the paper owner. When access becomes economics, you enter a different kind of wealth. You are no longer paid only for the year behind you. You are paid through claims on outcomes that may not arrive for years. Carry, vesting, exits, clawbacks, fund timing, tax planning. The money becomes larger, but less simple. At lower levels, money looks like income. It arrives, it clears, it belongs to you. Here, wealth starts to live on paper first. It sits inside future exits, fund documents, allocation schedules, and legal structures. You can be rich in a model before you are liquid in real life. Your net worth can rise while your cash remains controlled by time, markets, buyers, and performance. This is the part outsiders rarely understand. The higher you climb, the less wealth looks like money in an account. It looks like rights. Rights to future profits. Rights that depend on companies performing, debt markets staying open, management teams executing, and investors staying patient. And underneath those rights is a moral tension that never fully disappears. You call it value creation. Sometimes it is growth, better systems, stronger management, cleaner reporting. Sometimes it is layoffs, replaced executives, cost cuts, leverage, and labor being repriced until the numbers work. For the fund, it is return. For the limited partner, it is obligation. For the worker, it is a changed life. For the system, it is math. You do not need to hate it to see it clearly. But even as a partner, you have not created the game by yourself. To keep playing, someone outside the firm still has to believe you deserve more capital. Level 6. The institutional face. At this level, you are no longer judged only by the deals you complete. You are judged by what your presence signals. When limited partners look at the firm, they are not just studying performance. They are studying continuity. They want to know whether the returns came from a repeatable system or from one lucky cycle. They want to know whether the team is stable, whether the next generation can lead, whether risk is understood before it becomes visible. Your name now carries weight. But weight is not freedom. Every old decision follows you. A deal that performed well becomes proof of discipline. A deal that missed plan becomes a question years later. A senior departure becomes a signal. A delayed exit becomes a concern. A weak quarter becomes something that must be explained with calm, precise language. You are called powerful because people listen when you speak. But the truth is more controlled than that. You are being measured all the time. By investors, by founders, by lenders, by younger employees watching what kind of career they are trying to enter. By other partners who know that trust, once damaged, becomes expensive to repair. At this level, you do not fully live as a private individual anymore. You live as an institutional signal. Your judgment is a product. Your consistency is a product. Your ability to appear steady across cycles is part of what the firm is selling. And this is the quiet lesson of senior partnership. Return matters, but trust matters just as much. Because return explains the past. Trust decides whether capital shows up again. Level 7. The capital gatekeeper. The person who decides that may not look more powerful than you. They may not fly as much. They may not sit across from founders. They may not replace management teams, approve acquisitions, or argue over leverage. They may work inside a pension fund, an endowment, an insurance company, or a large institution whose name rarely appears in public stories about finance. But they control allocation. And allocation is where the hierarchy starts to reverse. One commitment can make a fund larger. One refusal can slow its momentum. One hesitation can spread quietly through the allocator community until fundraising becomes harder, meetings become longer, and confidence becomes more expensive. This person may earn far less than the partner pitching them, but they decide whether the partner still has a larger game to play. That is the inversion. The visible power sits inside the fund. The permission sits outside it. Still, the allocator is not completely free either. They answer to a committee. They follow a mandate. They manage risk policy, reporting requirements, public scrutiny, and long-term obligations they did not personally create. They are not the end of the machine. They are another gate inside it. And if you look one layer deeper, you begin to see what the entire system is actually serving. Level 8. The liability machine. The final level is not a title inside private equity. It is not partner, senior partner, allocator, or committee member. It is the system of obligations underneath all of them. Pension promises, retirement plans, insurance pools, university endowments. Long-term institutions that need money today to become more money later. Because somewhere in the future, a claim will come due. That is why the machine keeps searching for return. Not only because partners want to become rich, not only because allocators want strong performance, but because large institutions are built on promises that must be funded across decades. Public markets may not be enough, Bonds may not be enough. Cash is not enough. So capital moves into private companies, restructurings, leverage, operational plans, cost controls, growth targets, and exits. A real business becomes a financial instrument. A management team becomes part of a return profile. A worker becomes part of a margin structure. A customer relationship becomes part of a valuation. This is the final inversion. The senior partner thinks he controls capital. The allocator thinks she distributes capital. But both are serving something larger than themselves, a chain of future obligations that requires the present to produce. So what you climbed was never just a career ladder. It was a capital machine. At the bottom, you sell time and precision. In the middle, you sell judgment, access, and trust. Near the top, you manage reputation, risk, promises, and institutional belief. The question is not which rank is richest. The question is who controls the flow, who carries the risk, who receives the upside, and who gets turned into an input. Once you see that, the surface becomes less hypnotic. The titles matter, but the structure matters more.